Linda is 71 and her husband Tom is 73. Together, they make about $165,000 a year, and they're convinced the new tax break for seniors is for somebody poorer than them. They're wrong. It's theirs to take, but the way they're about to file, they can claim none of it. By the end of this video, Linda and Tom claim back $7,900 they were about to leave with the IRS, and the move takes one afternoon. Here's what's actually on the table. In 2025, a new law created a bonus deduction just for being 65 or older. $6,000 per person. So for a married couple where both are 65 plus, that's $12,000 off of your taxable income. And this wasn't always written into the tax code. Congress added it as a temporary sweetener for retirees. And like a lot of temporary things in tax law, it's only here for a few years. It covers 2026, 2027, and 2028. And then unless they renew it, it's gone. So this isn't a someday thing. It's a right now 3-year window. Miss it, and a couple like Linda and Tom hand the government about $2,600 every one of those years for no reason at all. That's the difference between taking one more trip a year or not. Same income, same life, just a number on a form they didn't know to claim. And it stacks $2,600 in 2026, again in 2027, and another in 2028. That's nearly $8,000 of found money sitting in plain sight. And the window only stays open for 3 years. Skip this first part and you'll never even get in the door. You leave the whole $12,000 sitting there. So here's move one, and it's one almost nobody over 65 knows to look for. This deduction is brand new, so your parents never claimed it, your neighbor has never claimed it, and a lot of tax software doesn't even flag it. It's not the standard deduction, it's an extra $6,000 stacked on top just for being 65 or older. So one spouse 65 plus, $6,000. Both of you 65 plus, $12,000. And that's not only for married couples. If you're single and 65, you get the $6,000 too. Your income line is just lower, and we'll get to that. The point is, if you're 65 or older, this is yours, and you can still be working. It's not about your age. It's not about whether you're retired. You don't have to itemize. You don't have to do anything fancy. You just have to be 65 or older, and you actually have to claim it. So how do you make sure that you actually get it? 3 things. First, if you use software, slow down on the screen that asks for your age or your birth date. That's the screen that unlocks this. Blow past that and the software assumes you don't qualify. Second, if someone prepares your taxes, then ask them one sentence. Did you apply the new senior deduction? That single question is worth thousands. A good preparer says yes. A rushed one may have skipped it. Third, this is the one that people don't realize. If you've already filed and you missed it, you're not stuck. You can amend a recent return and claim it after the fact. The money doesn't disappear just because you filed too fast. And don't assume your accountant automatically caught it. This rule is brand new, and this is the first real filing season. So even good preparers are still building it into their checklist. The people who will miss it are the ones who assume someone else is watching. And if you do your own taxes on paper, don't go hunting for some special form. The extra deduction goes right on the same line as your standard deduction. You just add the bonus amount on top. That's the whole mechanics. So Linda knows the $12,000 exists. That's step one. But the way the return is set up right now, they're on track to claim none of it. Now here's where it gets good. Knowing the deduction exists is worth a few $1,000s, but there's a second move stacked on top of it. And for a couple like Linda and Tom, that second move is worth more than the deduction itself because it protects something bigger. And the wild part, it doesn't cost them anything. They don't spend $1 to do it. They just move money they were already moving. Let me show you the line that controls all of it. Right here, $150,000. That is the line for a married couple. For a single person, it's $75,000. Stay under your line and you get the whole deduction. Go over it, and for every dollar above, the IRS claws back 6 cents of it. Linda and Tom are at $165,000, so $15,000 over the line. Now that overage by itself nibbles at the deduction. But here's why that same line matters so much more. The income that pushes them over it is the same exact income that decides how much of their Social Security gets taxed. One number, two problems, and one fix solves both. This is the move that locks in every dollar of the $12,000 and quietly protects their Social Security on top. Most couples never make it because nobody tells them the line is movable. Here's the thing about that $150,000 number. It is not your salary. It is your income in the way the IRS counts it, and you have more control over that number than you think. Linda and Tom need to move about $15,000 of income off the page. And here's the way that it's almost free. Tom is 73, and at 73, the IRS forces him to pull a chunk of money out of his traditional IRA every single year, whether he needs it or not. It's called a required withdrawal, and it lands right on his income line. But here's the thing, Tom and Linda already give to their church every year about $8,000. So instead of taking that as a withdrawal and then cash and writing a separate check, Tom has the IRA send $8,000 straight to the church. It's called a qualified charitable distribution. Watch what that does. That $8,000 counts as a part of the withdrawal Tom was forced to take anyway, so he checks off that box. But because it went directly to the church, it never lands on their income line at all. They were giving the money no matter what. They just changed which account it came from, and the $8,000 of the income vanished from the page. Then the second piece, in a year they don't need it. They stop pulling extra money out of their retirement accounts just because they can. Every dollar they don't withdraw is a dollar that doesn't push them over that line. Put those together, and Linda and Tom drop from $165,000 to under $150,000. The clawback stops. The full $12,000 comes back. And down here, under the line, less of their Social Security gets taxed too. One move, two wins. So now Linda's under the line, and she's claiming every dollar of it. But here's where a couple like Linda and Tom can still blow it. They hear, get your income down, and they panic. They yank out a huge amount from their traditional IRA in December just to get it over with. And they spike their income in the exact year that they were trying to protect. Or they do the opposite. They wait till they're filing in April to think about any of this, and when the year is already closed and nothing can be changed. So this line only cares about this year's income, and you can only steer it while the year is still open. Plan it before December, not on December 30th, and definitely not in April. So remember Linda and Tom's $7,900? That's the full $12,000 deduction claimed in 2026, 27, and 28, instead of the nothing they were about to leave on the table. 3 years, one income line, and $7,900 that stays in their account instead of going to Washington. And the only thing that changed is that somebody finally told them to look. If you're 65 or your parents are, this is the kind of thing that quietly costs a family thousands of dollars because nobody runs the numbers. Save this so you can run yours before you file. The income line that controls the deduction is the same one that controls how much of your Social Security gets taxed, and that one's worth even more. If this is the first video of mine you've watched, I teach people how to build wealth and retire early. So hit subscribe so the next one shows up in your feed.